Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at FOXX Development Holdings.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comment section below.
So let's get into the analysis. With FOXX Development, we're really dealing with one of the most classic, high-stakes, high-growth investment stories out there right now.
Yeah.
It's essentially a race between just exceptional top-line momentum and the brutal operational realities of scaling a business in this kind of environment.
That's the tension right there, isn't it? And it all starts with the revenue numbers. I mean, for anyone trying to understand the bull case for this company,
You have to start there.
you have to look at the velocity of their growth. It's not just growth, it's rapid sequential acceleration.
Exactly. I mean, when you just look at the raw data, the revenue trajectory it's pretty shocking compared to its peers. We're tracking a massive jump from, $43 million in Q4 of last year, surging to $54 million in Q1,
Right.
and then hitting $66 million in Q2 of this year. We're talking about huge sequential gains in just 9 months.
It's a parabolic move. But let's put that into context for everyone listening. Why does that specific rate of acceleration matter more than, say, a slow, steady 20% year-over-year increase?
Because it tells you that product market fit has been absolutely nailed. You know, when we analyze the broader tech sector, the average annualized growth is sitting around 8.9%.
Which is respectable.
It's respectable, yeah. But FOXX Development isn't just beating that, they are leaving it in the dust. This suggests they've achieved market leadership, or maybe they've tapped into a unique underserved niche.
So they can scale without that immediate, suffocating competitive pressure.
Precisely. This kind of sustained acceleration is the strongest indicator we have that their business model is fundamentally validated, which is, frankly, a rare sight even in a volatile market.
That strength is certainly fueling the enthusiasm, but high growth so often comes bundled with massive spending and heavy debt. What's the story with their financial foundation?
And that's where the narrative gets a little more comforting for investors, actually.
Yep.
Despite the explosive growth, FOXX Development maintains surprisingly low leverage. We're just not seeing heavy net debt obligations weighing down their balance sheet. They also have a manageable float around 1.35 million shares, which is healthy.
So what does that structural positioning, low leverage and a clean balance sheet, what does that give management the flexibility to do right now?
It gives them options, and that's crucial for a company at this stage.
Right?
The absence of massive interest payments or required dividend commitments means that every dollar generated can be strategically deployed. Management can choose to pivot quickly, reinvest in R&D,
Or focus on the big problem.
exactly, focus all their resources on solving the one major challenge looming over the company: profitability and operational efficiency.
Which takes us directly to that crucial balancing act, the element that makes this such a high-risk, high-reward proposition. Despite that stellar top-line performance, we absolutely have to address the path to profitability.
Absolutely. The tension is palpable. While the market celebrates the revenue, the reality is that FOXX Development reported a net loss of $9 million in Q2.
A $9 million loss.
And it's not just that. The quarterly margins remain unstable. This loss wasn't just a one-off. It speaks to the challenge of successfully managing costs as they scale up their infrastructure and expand operations so rapidly.
That's the classic startup trap, isn't it? Scaling up is often the most dangerous phase for a company because it requires this massive operational discipline to control expenses. If you can't contain the cost of growth, the high revenue won't matter.
Right. And this brings us to free cash flow, or FCF. For those who aren't familiar, FCF is essentially the cash a company generates after covering its basic operating expenses and capital expenditures. It's the purest measure of financial health.
And in Q2.
FOXX Development reported negative FCF of $7 million.
Okay, so negative FCF always sounds like a huge red flag to new investors. It means they're burning cash faster than they're bringing it in. But there is an important nuance here that kind of changes the story on that $7 million number.
The nuance is everything. Yes, they are burning cash, but the rate of cash burn is actually narrowing quarter over quarter.
That's the key.
That is a critical indicator because it suggests that the improvements they're making in gross margins and operational efficiencies are starting to take hold. It means that as they process more revenue, the cost structure isn't ballooning at the same pace.
They're getting closer to that operational break-even point.
Exactly. So the goal for management isn't just to cut costs arbitrarily, but to achieve operating leverage, to make it so that the next dollar of revenue costs less to acquire and service than the last one did.
And we know management is focused on this.
Laser focused. It's all detailed in the recent corporate filings. Their 10-K from October 2025 specifically confirms a commitment to organizational changes, implementing cost controls, and ruthlessly streamlining their product offerings.
So they're basically telling the market, we hear you, we're on it.
Yes, this is management acknowledging the scaling risk and making efficiency, rather than just pure growth at any cost, the priority moving into 2026. This level of transparency is critical.
Speaking of confidence, it clearly hasn't been shaken yet, because when we shift from the fundamentals to the technical picture, the chart is just screaming upward momentum.
It really is.
We saw that significant move recently, a 7.44% advance on July 25th, which confirmed a breakout above a major horizontal resistance zone.
And technical analysts, we pay close attention to breakouts because they often precede swift and powerful movements. What's particularly compelling here is the alignment of multiple technical indicators. This isn't just a fleeting spike.
So tell us about those confirmations. What signals are telling us this uptrend is for real?
Well, first, the moving averages are perfectly aligned in a bullish configuration. The 50-day is trading above the 200-day moving average.
Classic golden cross setup.
Standard technical language for confirming a long-term uptrend, yeah. Second, the 3-month moving average convergence divergence, or MACD, has issued a clear buy signal.
Okay, let's pause there for a quick definition. For listeners who might not be looking at charts all day, what is the MACD signal telling us in simple terms?
The MACD is basically a momentum indicator. It tracks the relationship between two moving averages of a stock's price. So when it issues a buy signal, it means that the short-term momentum is accelerating away from the longer-term trend.
So buying pressure is getting stronger.
It's strong and it's rapidly increasing. It's a classic signal that a new, powerful phase of upward movement might be starting.
And crucially, this price rise isn't happening on thin air, right? There's volume behind it.
A ton of volume. We've seen increased volume accompanying the price move, which is the necessary fuel for any major technical breakout. Strong volume validates the buying conviction.
Okay, so based on this technical setup, where could we see this going in the near term?
Well, using some specific chart pattern analysis, the stock projects a potential target of around $7.82 during the next 3 months.
That's a powerful target.
Yeah.
But what about the risk? What's the floor? What level do investors need to see hold to maintain this bullish thesis?
The crucial support level right now sits at $6.17. If the stock were to convincingly fall and hold below that $6.17 mark, the technical picture would get a lot cloudier.
The breakout would be in question.
It would need a serious reevaluation, yeah. It might suggest the breakout was a false signal or that those fundamental concerns are starting to overshadow the positive momentum.
Okay, so now we get to the timeline, which is absolutely packed with pivotal dates moving into the new year. Investors really need a scorecard for this one.
They do, because the next 3 months are all about transparency and confirmation. We're moving into a phase where the market is hyper-focused on 2 key things.
Which are?
How is institutional money reacting to these operational changes? And are the cost controls actually working?
Let's circle those institutional flow dates first. The first critical checkpoint is December 20th.
That's the due date for the 13F filings.
Right.
So for anyone not deep in finance, the 13F is a public report that large institutional managers, the big funds, the whales, have to file every quarter to show what they own.
So on December 20th, we get to see if the big money is buying into this turnaround story.
Exactly. We get to see how they reacted to the Q2 numbers and the management's focus on cost cutting. If institutions aggressively increase their positions, it signals strong confidence.
And institutional sentiment is a massive leading indicator. Closely following that, on January 17th, we have the ETF quarterly rebalancing.
That date is just pure volatility. Passive index funds and ETFs have to adjust their holdings based on updated weightings.
Which can cause big price swings that have nothing to do with the company's performance.
Exactly. It can lead to non-fundamental buying or selling pressure, which can really move the needle for a stock like FOXX Development.
But if we connect all this back to that fundamental dilemma growth versus profitability, the single most critical date on the calendar has to be the Q4 2025 earnings release.
Projected for February 12th.
That's the one.
February 12th is the moment of truth. This is when management needs to provide irrefutable proof that the plan is working.
The market needs to see that all this revenue growth is finally resulting in, that operating leverage we talked about.
And a significant reduction in those operational losses. That Q4 report is everything.
It is, but before we even get to February, there are other catalysts that could drive some immediate upside, right? Starting with Q3 earnings due in August.
Right. Expectations are incredibly high for Q3. Current growth rate suggests that year-over-year revenue is expected to nearly double.
Wow, that is a high bar.
An extremely high bar. But if they meet, or better yet, exceed that target, the stock will likely see an immediate, forceful reaction to the upside.
We also need to be monitoring any official corporate announcements, specifically things like confirmed partnerships or big enterprise deals.
And those aren't just rumors. Those require an 8K filing to be taken seriously.
An 8K being the official SEC filing for major events.
Exactly. An 8K confirming a major multi-year enterprise partnership, for example, would instantly de-risk future revenue forecasts and could re-rate the stock overnight.
And finally, there are these persistent rumors floating around about new platform or feature launches slated for early September.
Right, and those launches, if they happen, could provide a quick short-term boost. But this brings us squarely into the territory of speculative buzz, the unconfirmed market chatter that often prices in future potential.
And the most prominent rumor right now is centered on artificial intelligence. We're hearing this persistent chatter about FOXX development expanding into AI-powered verticals.
And potential partnerships with a larger tech platform to accelerate their digital offerings.
Yeah.
This is where the risk turns into potentially explosive upside. I mean, while it's unconfirmed, the immediate integration of high-margin AI-powered features would fundamentally change the margin profile of the company.
They'd be accessing the hottest tailwinds in the entire market.
Exactly. Instead of just scaling their current service, they'd be moving up the value chain, providing intelligence, not just a platform.
Which would justify a much higher valuation multiple.
No question.
And beyond the AI speculation, what are the longer-term chatter points we should be aware of, especially around corporate actions?
There are a few things. First, there's always the M&A target speculation. Companies with this kind of confirmed explosive revenue growth.
But that haven't quite mastered profitability yet.
Oh, they often become very appealing targets for larger tech companies looking to buy growth, and acquisition is always on the table.
And what about shareholder value initiatives? Any talk there?
We're also hearing some speculation about a possible share repurchase program. Now, this would likely only happen after those crucial Q4 results.
Assuming their financials stabilize.
Right, assuming their liquidity metrics and FCF path improve dramatically. We've also seen chatter about a potential board recomposition in early 2026, aimed at bringing in heavy hitters to strengthen governance.
So, stepping back, what's the ultimate thesis here if we account for the long-term sector tailwinds?
The structural argument is strong. The broader advancements in tech, especially in digital transformation and the need for AI infrastructure, are inherently favorable to FOXX Development's underlying model. They are positioned perfectly to capture this massive spending shift. But
There's always a but.
it's conditional. They absolutely must execute on the operational front.
It really sounds like FOXX Development is the ultimate high-wire act right now. The fastest revenue growth in their sector, paired with the existential threat of cash burn that needs to be brought under control by February.
That's it, exactly. FOXX Development presents a fascinating dichotomy. They have achieved truly exceptional top-line momentum, putting them in an elite class of growth companies. But they are simultaneously navigating these crucial, often deadly, early-stage profitability challenges.
So the next few months are everything.
The next few months, and especially that Q4 earnings report in February, will be the true test of management's ability to convert all that rapid growth into scalable, sustainable operating leverage.
So the question for you, the listener, is whether you believe management can deliver the operational discipline required to match that incredible revenue growth, or if they'll fall victim to the scaling trap. That February date is definitely the ultimate milestone to circle on your calendar. Keep track of those filing dates and the earnings expectations we discussed. Thanks for tuning in to Smart Wealth with Joshua, and please remember to subscribe and like the show for more analysis.